Hey guys, hope you're doing well out there. Today we are taking a look at DocuSign, ticker symbol DOCU. They reported their Q2 2023 results last week after the bell. We'll take a look at their press release, dive into their all-important statement of income, cash flows, and balance sheet. And as always, take a look at it from a technical perspective. This one has been making a long-term downtrend and it's coming to a critical level. We'll see if that can be a sign of a buying opportunity. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button. We are on the road to 500 subscribers and it would mean a lot. DocuSign stock down roughly 12% on a year-to-date basis, down even more, close to 14% over the past 1 year, even over the past 5 years. This stock has made you no money as it's down roughly 7% and once nearing all-time highs of $300. The stock is now down to $50 and close to a $10 billion valuation. This was one of those pandemic darlings that has absolutely seen its valuation be compressed, and for good reason. We'll jump into these numbers. They reported Q2 revenues of close to $688 million. That represented an 11% increase on a year-over-year basis. Now keep in mind, this stock is trading at a forward price to earnings of close to 19 times, and that's very, very compressed compared to what it used to be trading at just a year to 2 years ago back in the pandemic quarters. Now, 11% growth on that year-over-year side is not as explosive as we have once seen from DocuSign in the past. We see subscription revenue was the majority of that, coming in close to $670 million. That grew at 11% on a year-over-year basis. And their other revenue segment, which is professional services, which is far, far smaller at just $18.3 million, that grew at a slower pace, close to 8% on a year-over-year basis. Now, this did beat analysts' expectations. They were closer to $677 million on that top line, so a roughly $10 million beat on that top line. You see non-GAAP gross margins coming in at 82%. That's that phenomenal software-like margins you see from DocuSign. Taking a look at non-GAAP net income, that came in at 72 cents per diluted share compared to 44 cents per diluted share same time last year. If we take a look at analyst expectations, those were closer to 66 cents on that non-GAAP EPS side. So a nice beat on that bottom line as well. So a double beat for DocuSign. We look back over the last 5 quarters and you can see they have beat EPS on every single quarter consistently. Now, what is concerning is this upcoming Q3 and Q4. You see from an EPS side, growth is supposed to decline on a quarter-over-quarter basis. And especially for Q4 2024, they are expected to post EPS of 59 cents per share. Compared to last year of Q4, they posted EPS of 65 cents per share. So you see growth on that bottom line in Q4 is expected to turn negative. As we look out further over the years for DocuSign, you see this past year, it's expected to grow on that bottom line roughly 30% on a year-over-year basis. But you fast forward to next year, that growth is absolutely supposed to come to a screeching halt as EPS is expected to grow to just 4% on that year-over-year basis. You even look at that top line growth in that mid to high single digits. Certainly, this does not deserve a premium price to earnings or price to sales multiple when they're only posting growth of low single digits. Moving on to other highlights they presented in their press release. So DocuSign did announce some new products in this most recent quarter. Notably, they are launching a new ID verification tool that is using AI-enabled biometrics to confirm signers say who they are. And along with that, DocuSign did increase its stock repurchase program from $300 million in this most recent quarter up to $500 million of outstanding common stock. Now, there is no end date on this stock repurchase and there's no minimum purchase commitment, and so DocuSign will exercise this $500 million stock repurchase on their own basis. Taking a look at forward outlook for this upcoming Q3 ending October 31st, so just in about 2 months, DocuSign is expecting top line revenue to come in between 687 to 691 million. Analysts' expectations were a bit on that higher end, closer to 690 million for that top line. Taking a look at full year revenues, those are expected to come in between $2.725 to $2.737 billion, and expectations were closer to the high end of $2.73 billion. So DocuSign does certainly need to come into closer to their higher ends of their outlooks in order to just meet Wall Street expectations. Taking a look at the statement of income, DocuSign paints a 3 months year-over-year picture along with a 6 months year-over-year picture, and all these numbers are in thousands, so add 3 more zeros to the ends of these numbers. You see total top line revenues coming in at $687 million. Same time last year, that was sitting at just $622 million. That represented 11% growth on that top line. Now, when it comes to the cost of revenue, we do know DocuSign has very strong gross margins at close to 82%, as it is a software as a service business. But what's interesting is that only applies to their subscription business, really, because on their professional services business, they are actually running at a loss, and they have been for quite some time. So taking a look at their professional services business, they generated just $18 million worth of revenue when they spent $29 million generating that. So they're essentially giving away their professional services at a loss for free. And on a 6 month basis, that paints a similar picture, as they spent $56 million in order to generate just $40 million worth of revenue. So in my opinion, DocuSign needs to manage this side of their business far better, if not cut it out as a whole, and that should see their stock price respond positively, as they are running this business on a loss, which is affecting not only their margins, but more importantly, their bottom line. Now, the bulk of their revenue does come from subscriptions, and the margins on that is absolutely phenomenal. As you see, they spent roughly $116 million worth of cost in order to generate $669 million worth of revenue. We see on total revenue of close to $687 million, we generated a gross profit of close to $542 million. That is up from same time last year, which was closer to $485 million. So strong growth on that gross profit side. Now, similar to other stocks we analyzed, we took a look at Salesforce last week, and we noticed where they had to pull levers was in their operating expenses side. And I'm seeing a similar picture from DocuSign, where they can really control costs on their operating expenses in order to drive profitability. Now, the question is whether management recognizes this, and will they do it over a long period of time or not. We see they did do it on their sales and marketing side, as that actually ticked down by close to $30 million, which is impressive. That came down to $294 million for the last 3 months, compared to $323 million same time last year. You see R&D did tick up roughly $9 million. Now, G&A is where the big issue is for DocuSign, as they should look to control costs on this G&A side. That exploded from $76 million same time last year all the way up to over $100 million in 3 months. That is absolutely incredible, and in my opinion, they are spending wildly on that G&A side. On a 6 month basis, it paints a similar picture, as 6 months of 2022, they had spent roughly $139 million on G&A, and 6 months through 2023, they have spent over $200 million on G&A. You see, they also take a massive restructuring related charge in these last 6 months, close to $30 million, likely due to restructuring parts of their business and cutting their workforce. Tallying up these operating expenses, you get to total operating expenses of roughly $535 million. So on $542 million worth of gross profit, you subtract $535 million of operating expenses, and you generate a marginal income from operations of roughly $6.6 million. Now, that does seem small, but that is a huge improvement from same time last year, when they were generating roughly a $41 million operating income loss. And so looks like DocuSign has just turned the corner on an operating basis towards profitability. On a 6 month picture, this looks very similar, as over the last 6 months in 2022, they were operating at roughly $60 million worth of losses. And now over these last 6 months, they've eked out nearly a $2 million operating income. After adding on some interest income and paying some income taxes, we get to a net income figure of roughly $7.4 million. Same time last year, that was at a loss of roughly $45 million. We come to an GAAP EPS figure of roughly 4 cents per diluted share. Now, we see their weighted shares outstanding have been increasing, and just over the past year, this has up roughly 4%. And so when you see DocuSign announcing a nearly $500 million buyback on a $10 billion company. That would represent roughly 5% of their market cap. However, when they're diluting you at roughly 4% on a year-over-year basis, that buyback is essentially just canceling out them diluting you on a year-over-year basis. And so do keep that in mind, is that DocuSign does provide a ton of share-based compensation. And so any buybacks really just go to mitigate that rather than actually decreasing the weighted average shares outstanding. We come down and take a look at their stock-based compensation as part of their operating expenses. So you see on roughly $100 million worth of G&A operating expense, about 34 million of that was just stock-based expense. And so certainly DocuSign can control their stock-based compensation. And look, employees over in California won't be working for free. And so DocuSign has to make decisions as to whether reduce compensation packages or do layoffs altogether. As you see, stock-based compensation is a massive part of their operating expenses. And certainly if they can look to cut that, they can look to drive profitability and hopefully increasing their bottom line earnings by more than just 4% on a year-over-year basis. Moving over to the balance sheet at DocuSign, all things considered, looks fairly healthy. You see cash and cash equivalents in this most recent quarter sitting at roughly we'll round it down to $1 billion. 6 months ago, that was at roughly $720 million. So they've added some cash to that cash pile. We see they have roughly another $400 million worth of accounts receivables. Now, DocuSign has lots of large enterprise customers that sort of operate on longer term time horizons. And so they have these account receivables over the subsequent quarters, which they write down in their assets for now. Overall, total current assets totaling to roughly $2 billion. Total assets coming out at close to $3.2 billion. Moving on to current liabilities, they do have some accounts payable, some accrued expenses. However, the majority of their current liabilities come from contract liabilities, and so DocuSign might have provided their business to certain customers and have not received payment yet. And so as they operate on longer term contracts, they have to write down that as a liability, which will turn into an asset in subsequent quarters. And so you see total current liabilities coming in at roughly $2.2 billion. That is more than your total current assets. And so that's not good to see. However, not a huge deal, as they have a large chunk of contract liabilities, which will slowly carry over into their assets as the subsequent quarters play out. All things considered, not much to worry about when it comes to the balance sheet over at DocuSign. Moving on to the statement of cash flow, they pull down, this is a 6-month picture, so they pull down roughly $7.9 million worth of net income over these last 6 months. Get to add back some depreciation, amortization, some non-cash expenses. You see roughly $300 million worth of stock-based compensation. And so certainly when they're generating roughly $542 million worth of gross profits in one quarter and compensating their employees close to $300 million over 2 quarters, that is a lot of stock-based compensation. And certainly if I was an investor, that is something I would like to see DocuSign control. They do add back roughly $100 million worth of accounts receivable. And so you see net cash provided by operating activities over these last 6 months at close to $450 million. That is quite strong on a cash flow side. If you annualize this, that would get you close to $900 million on free cash flow. Now, this is a $10 billion company, and so you apply roughly a 10-11 times multiple on that cash flow basis. Not wildly expensive for a software company. And so certainly DocuSign's valuation has compressed and come down to what you could call attractive levels. It's just, can they see this momentum continue and prove, can they grow at a clip faster than just 4% on that bottom line? Now, they do purchase some marketable securities at the tune of roughly $174 million over these last 6 months. We see they did repurchase roughly $70 million worth of common stock over these last 6 months. Same time last year, they had purchased close to $25 million worth of common stock. All things considered, they added roughly $300 million to their cash pile over these last 6 months. And so that cash now coming in at roughly $1 billion. Moving on to the technical charts for DocuSign. Now this is the past 1 year, and each candle here represents 1 day of trading, certainly locked in a downtrend for the majority of this year. Now over the past 5 years, it doesn't get much prettier. In fact, it gets quite a bit more ugly. As you see, DocuSign, once sitting at all-time highs of close to $311, has now fallen over 80% and is close to $50 per share. This was one of those pandemic darlings that saw its valuation really just take off during COVID, and you see they signed a lot of customers. They were growing very strongly at that time, but then the valuation also began trading at close to 20 to 30 times sales, and certainly that over a long period of time is not sustainable. And so as the valuation has come down, it's up to us to see if DocuSign is now a worthwhile investment and possibly even oversold. Now over the past 1 year, this has been locked in this descending wedge, and certainly it looks ugly from a technical perspective as well. However, it is coming to a key level of convergence. You see this descending trend line of lower highs is looking to converge with this long-term support at close to $47 per share. Now certainly this can be seen as a bullish pattern. However, I would wait in order to jump into DocuSign, as the air has absolutely been taken out of this stock, and so I would want to see a breakout above this line of lower highs, notably a breakout above, I want to call $53, $54 per share. If DocuSign can put up a strong green candle above that, I would know that, okay, this trend line has been broken and it can see continued moves to the upside. Now, certainly, I wouldn't want it to break below this $47 per share. It has done that a few times in the past and has even come down close to $40 per share, but certainly there's not a whole lot of volume at these levels. And so if DocuSign breaks below this $47 support, it can come down in a hurry close to $40, even below at roughly $35, $36 per share quite quickly. And so I would watch this $47 of support like a hawk, and certainly if it comes down there, bounces up, and then breaks out over this $53 per share level, that can be considered bullish for DocuSign. And while certainly this has been in a very ugly downtrending pattern, it can see rallies. As you see, back in May of 2023, it rallied close to 30%. And so certainly pairing continued improvement in DocuSign's fundamentals with a bullish technical reversal, that can be signs for strong capital gains. And while I would stay out of DocuSign for now, I would keep an eye on this descending wedge, and more importantly, keep an eye on this $47 of support. And if it can break out over $53 per share, that can be considered bullish for DocuSign. This is not one stock that I'm particularly interested at this point, as while the valuation has come down, it does still have lots to improve, especially on that operating expenses side. And I do think there are software companies out there with a much larger economic moat, namely a Microsoft, even a Salesforce, as DocuSign plays in just one vertical, and that's the e-signing of documents. Certainly, if the valuation continues to get compressed, I wouldn't put it past this company to become an attractive acquisition candidate for something like a Microsoft in particular. And so I would keep an eye on that, and we'll see if that transpires. That was DocuSign for you guys. Let me know what you think of this one in the comment section below. Are you buying, selling, or holding DocuSign at $50 per share? As always, thanks so much for listening, and I'll catch you guys in the next video.